Rolling back regulations will be a top priority for the Trump administration. The Senate Banking Committee is expected to get to work on that right away as well. Joining us right now is South Carolina Republican Senator Tim Scott. He's the chairman of the Banking Committee. And Senator, thank you for being here with us.
Yes, ma'am.
You know, there's so many times we get to talk to you, and we rarely really get to drill down on what you're planning to do with the Banking Committee.
Yes.
You've got big plans for the 119th Congress.
Yes.
What are the top couple of things on your agenda?
Yeah, for me, it's making America's economy work for the working class people. I grew up in a single-parent household, and so, Becky, I'm thinking about those folks today who are working class folks who struggle to make the end meet. It's like they have too much month for their money. And how do we do that? Well, number one, I think the regulatory rollback that we're talking about, the reset, we want a responsible level of regulations, not an oppressive level of regulations. You think about Basel III. Here's an example of an oppressive level of capital on the sidelines. The more capital on the sidelines, harder to get a mortgage, harder to start a small business because you need capital. Second area that I'm looking at is capital formation. I'm putting together a working group, hopefully led by Dave McCormick, who understands capital formation. My theory is that as a small business, it changed my life, it changed my mother's life. It allowed me to live the American dream beyond home ownership. And that requires having a place where you can ask for the money you need in your hometown. That means we have to reset the capital requirements from an SEC perspective, the regulatory environment from the SEC perspective. Number three is home ownership. Interest rates spiking because inflation was so high, making home ownership for so many Americans outside their reach. How do we do something about that? Well, number one, most of the homeowner question is a local question. I think we can provide some incentives, whether we use our CDBG grants as a way of creating the community development block grants that would allow us to provide some incentives for states and localities to create more space for homeowners.
Okay, those are all pretty worthy issues. You know, Basel III, again, for those who aren't familiar with it, these are new regulatory approaches that was going to require banks, big banks, to hold more of their capital. The big banks had pushed back against that, saying it meant that they would not be able to lend. And it's not the big companies that haven't been able to get access to cash, it's the small ones.
Yeah, and if you think about the trickle-down effect, anytime you have Basel III as a proposal, it's not going to just affect the G-SIBs of the largest banks. The banks of $10 billion, $25 billion are small community banks. They can't meet the requirements to grow. And so what they're looking at is consolidating. The more consolidation we see in the smaller banks, the fewer community banks there will be around the country. And that stymies the actual activity that leads to small business growth. I'm talking to a number of small banks or independent banks that say the level of regulatory oppression has never been higher.
The idea of mergers and activity, M&A activity,
yes.
That's been brought up with regards to the small banks, the community banks, too. Do you think that there will be an increase in those banks getting sucked up or bought up by other banks? What do you do about it?
I do. Well, the first thing you do is you reset the regulatory environment, because the number one reason that we continue to hear that banks are looking to consolidate is because they can't meet their business plan doesn't work without consolidation. Think about the fact that in the 80s, early 90s, we had 14,000 banks. We're down to 4,000, and it's consolidating. What does that do? It puts more pressure on the non-bank opportunities, or more opportunities in that space. What that means is fintech and non-bank and perhaps unregulated areas of our economy will be looking for loans in that space. So giving banks a easier path forward from a regulatory standpoint, still holding their feet to the fire when necessary, but making it easier for them to have character loans, to lean into their communities based on their relationships, is something that changed my life. We wanted to change more lives and to do it in a responsible fashion.
Let's talk about insurance companies, too. We've been watching insurance companies, what's happening in California right now with the wildfires, what's happened in places like Florida with flooding that's come in. Are there reforms that you think can and should be put into place, or how do you think the industry is going to evolve, too? Because you can look at 15 different reasons that there are huge problems in the insurance industry.
100%. I'd say two things. Number one, the state-regulated insurance framework that we have is fantastic, the best in the world. Number two, California and Florida, two very different markets. In Florida, the average homeowner rate's $6,300. That is just unaffordable for the average Floridian.
And yet there are insurance companies who won't do business there or write policies there because they can't cover the risk.
Yeah, because when you talk about the risk, you're talking about the PMLs back in the insurance days, the probable maximum loss. The events of natural disasters happening in our states today makes it very hard for an insurance company to find that actual rate from an actuarial perspective. In California, a bit of a different mix there. The catastrophic occurrences from fire that happened in California, that we are still seeing the devastation in Los Angeles, we certainly should stop and pray for those families, think about the loss of homes, but we also have to think about the absolute dereliction of duty from the governor to the local community, where they did not follow the mitigation strategies that they put in place for themselves, making it almost impossible to find an actuary that says, we can do business there. The end of the day there is that they need to follow their own mitigation strategies, number one. Number two, you need to have a comprehensive conversation about insurance state to state, and then talk about the natural occurrence, the natural disasters that are occurring across our country, and have a serious conversation about that. On the coast, we think about hurricanes. Midwest and West, we think about fires. In the middle of the country, we think about tornadoes.
Yeah.
So we need to have a comprehensive conversation without eliminating the state-regulated insurance framework that we currently have.
But let me ask you this. There was a great piece in the Wall Street Journal over the weekend by Greg Ebb that basically said the insurance industry is facing this huge crisis event where you have to figure out, are these losses, are there situations where the state regulators will allow insurers to raise prices so that they can actually get the risk that they're taking, or are we going to basically take over and say the public is going to, tax dollars will step up and pay for any of the losses? What's the answer?
Well, Becky, we've got to figure out how to make sure that the insurance companies remain the first line of defense for this nation. It cannot be the taxpayers. You just made a very important point, though, Becky. The bottom line is simply this. In California, they did not allow the insurance companies to increase the rates for the last several years.
Same story in Florida. And the FAIR plan that you have in California and the state plan in Florida are both on the verge of bankruptcy.
Well, and so is the NFIP. We've bailed them out once, the National Flood Insurance Program. Sorry,
right,
the acronyms. Losing billions of dollars. That's why we have to figure this out. If you think about the flood insurance program specifically, 3 states account for more than 40% of the premiums that come into the National Flood Insurance Program: South Carolina, Florida, Louisiana.
Okay.
And so the bottom line, unfortunately, though, is flood occurrences are happening in New York, New Jersey, and beyond. And so having more folks involved in that process will be really helpful from a rate sufficiency perspective. Until we understand and appreciate the catastrophic occurrences around the country, we will not be able to figure out how to understand the probable maximum loss as it relates to natural disasters versus your normal perils of fire, theft, and others.
Is the federal government going to play a bigger role? You said changing all of this with keeping the state regulatory framework there, but do you think the federal government will play a bigger role here?
We should engage the insurance industry to understand what it takes to be rate sufficient. That is something that the American people deserve to understand. And we need to have a conversation with our states about making sure that they're following their own rules and laws to make sure that we reduce the threat of fires in California. When you can go to a fire hydrant and not find water, when you have sprinklers that they don't work, these are massive problems that can prevent the actual devastation that we're seeing in California. Not completely, but a lot of it.
Senator Scott, thank you very much for your time. We hope to talk to you a lot more as we get a little deeper into this Congress, too.
Thank you very much. Look forward to coming back.
Appreciate it.